So in this video, I'm going to talk about what is an institutional candle. Now, an institutional candle is the main thing that we base our trades off, and it allows us to see the market footprint of the institutions. This also allows us to get incredibly high risk to reward, and it allows us to have movements that are completely backed by the institutions. So when identifying an institutional candle, how do we necessarily spot it? So if I go onto a chart, let me just draw an uptrend. So if you'd watched the previous structure video, you'd know this is an uptrend because we're creating high highs, high lows, etc. Now, after an impulsive move, what we'd expect to happen is a retracement. And notice deep within the retracement, at some point, we then get another impulsive move. Now, why does this happen? Well, first of all, this happens because it is an institutionally backed move. Okay, so this means that at a certain point, institutions get in with their big money and force price up or down. Okay, so with that in mind, how do we potentially identify what an institutional candle is? Well, the basic understanding is that it is the last down candle before the up move that breaks structure, and vice versa. So the last up candle before the down move that breaks structure. So in this example here, let me just use this candle as an example. Now, I'm going to make this red, and then I'm going to put a candle next to it, which is going to be a green one, just to indicate a buy and a sell candle. Okay, so what we have here is we've got a sell candle and we've got a buy candle. And effectively, the understanding is that at this point here, the institutions, they sell down and then they buy back up. Now, why do they necessarily do this? So first of all, they do this to actually take liquidity or fill imbalance, like we mentioned in a previous video. And when they're in this position, they'll be in a sell position and a buy position at the same time. So what this means is that they are hedged into the market. So they're selling and they're buying at the same time. So that means when price does actually move upwards and they're still in their sell position is massively in the negative. It's millions and billions in the negative. Okay. And at some point, they want to get out of that sell position. Now, with the banks and the institutions not trading with a stop loss, they can let price move up as high as it likes before then returning price down to this level. Now, when price does actually return to this level, this is called a mitigation. So what does that mean? Price returns down to this level and they get out of their sell position. So if you remember from the candlestick anatomy video, the open of this sell candle is up here. This is where they open their sell position. So that means logically, in order for them to get out of their sell position at break even, so they're not losing any money, they need to get out of this position. So that means when price returns down to this level, they then get out of their sell position. And when they get out of their sell position, all of that selling pressure at this point is released. So there's no longer a sell position and there's only buying pressure. And when there's only buying pressure and no selling pressure, boom, price goes up. And there is an institutionally funded reaction there. So now let's look at it from the other direction. So what we have here, we've got an impulsive move to the downside. We've got correction. We get another impulsive move to the downside. And we leave a bit of a clue over here. Now, with this clue, we can understand that we've created this impulsive move. We might have a bit of imbalance maybe. And we've left this significant up candle before a down move that's broken this prior low. Now, at some point, when the price decides to return to this level, what we can then expect is, because the banks are in a buy and a sell at the same time, and their buy position is in drawdown, so it's in the negative, they need to get out of their buy position. So what do? They return price to that level. They get out of that buy position at break even, which only leaves the selling pressure. And because there's only selling pressure and the banks are in control of the market, price gets forced down to the downside. Okay, so with the understanding of what an institutional candle is, understanding how the banks and the institutions can leave their footprint in the market, this is how we base our trades. So we can base our trades off the institutional candles. We have the entries where the institutional candles would be mitigated and then stop losses above those institutional candles. And this will allow us to get the insanely high risk to reward. So now let's have a look at an actual candlestick chart. Now what can we see here? we can see a low that gets created down here. We can see a high. We can see higher low and a higher high. So we know that we're in an uptrend, and we know that we've created an impulsive move, and we've actually started to create a bit of a correction. Okay, so with that in mind, what we want to be doing is looking for a potential buy. Now, using what we understand about imbalance, liquidity, and actually an institutional candle, what we can start to do is build a bit of a picture. So let me just roll this back a little bit. Let's say we're in this position. We've just created an impulsive move, and we've actually created what looks to be some relatively equal highs up here. Now, what do we know lies beyond equal highs? We know there's liquidity. So what I'll do, I'll just put a little money sign there. This is liquidity. This is going to be our target. Okay. Now, what else can we spot? Well, we can actually spot a little bit of imbalance down here. So we can understand, okay, maybe that needs to get filled. Now, with the understanding of what an institutional candle is, it's technically the last down candle before the up move that breaks structure. So you may be thinking, okay, well, what's up with this candle? That's the last down candle before the up move that broke this high. Why are we not picking that one? Well, the reason being is just because we've got this imbalance down here. And actually, at some point, we need to fill in this imbalance. So it would make sense for us to fill it in and then move off from there. So let's have a look at the candle below that. As you can see, we've got this down candle, and this forces this impulsive move. So what we can do is let's just see how this potentially would play out. Okay, great. So we see the imbalance gets filled, our institutional candle gets tapped into, we get a move up, and then we take out this liquidity. So this is the basic understanding of an institutional style setup. So in future videos, I will actually go a bit more into depth on how we can refine our institutional candles and how we can get even tighter stop losses, and also how we can improve the strike rate of this strategy in itself by adding extra confirmations into the mix.